we finally out of the worst? And do you see, and I know realtors tend to be perpetually optimistic, but realistically, do you see the next 12 months being better than the last?
And I definitely believe we are out of the worst. And
Why? What do you see that makes you feel that way?
because we are recovering. And we are technically out of the recession. Can have a double dip if you're out of the recession. We're seeing movement across the board now. It started in $1 million under, it moved up, and now all price points are moving. It's a stable market we're seeing, and a recovering market.
Howard, do you agree with that?
No question about it. What we've seen in the numbers for the first 8 months anyway, that in Douglas Elliman, we've had record volume and record profits.
How much did you stress?
At prices, well, prices about 20% less on average. And we've seen it at all levels of the market, the low level, the middle, and the high. And I don't necessarily agree with Diane as it relates to next year is going to be better. I think that the market has reset. We are where we are. I don't think it's going to get much worse, and I don't think it's going to get much better for a while. I think this is the game.
Define a while. Talking about a couple months, a couple years?
No, you know, who knows? I mean, it could be 3 years, could be 5 years, could be 2 years, I don't know.
Dan, your industry perhaps hit harder than almost any other. I mean, to Howard's point, I know Diane brought it up about the recession. I know that the NBER says we're out of recession. Do you believe that we are out of a real estate recession or a construction recession?
We have seen on the private development side that there was a real hiatus last year of people even talking about new projects. I think Howard's right. There is a reset. I think the reset's happening. Now people are getting used to a new way of doing business. We're seeing a much greater volume of our developers, the private developers in the industry, whether it's in residential or hotel or condominium, office building, starting to talk about restart the discussion about projects that they put on the shelf a year or two ago. We used to be able to borrow 5% or borrow 95%, put 5% of equity up. Those days are gone. So people are having to relearn how to make these projects efficient and how to justify them. There is the other side of the construction business is that there is a tremendous amount of public work happening. You mentioned the project that we're involved with downtown. That's a public-private project. A lot of the money at the World Trade Center site is state and federal, and some of it is private. And there is a huge resurgence of that type of work around the country. We see it, and part of it's because of the stimulus. Part of it's because the country just has to continue to reinvest in its infrastructure.
Jeff, you one of these companies that wants to start new projects?
I would say I completely agree with the haves and have-nots in terms of cities across the United States. I think you really have New York and Washington that stand out up here, and then you have the rest of the country in terms of if you would call it an economic recovery. You wouldn't consider, or certainly we wouldn't consider, I think most people would agree, starting development outside of those two cities today.
We deal with a little bit lower than that, and I'm willing to do a deal where I can come in, whether it's a new build or a renovation, about 400,000 or 500,000 a year. Then it works, cash flow moves, and then you can make money. As far as residential, I would look to do a very special unique kind of property. I might be willing to pay. Speaking to Jeff and Dan backstage, one person was asking me to spend $500 to put in FIR to do a small condominium project. And that's what I'm thinking about it, assuming that I can get like between $2,500 above the sale price. But I feel that this is the time, this is the last 24 days of session that I've been in, that's the time to start looking around for those selected opportunities.
But only here in New York?
Well, in New York, I'm trying to do a deal in London, which is very comparable to that, which is very
Which is New York with funny accents and narrow streets.
I'm in South London, but also Miami, do things.
Bob, you're involved in all kinds of different transactions. I know you and I have spoken, you've been on the show, and volumes are good for you. But is pricing good for anybody?
We've seen so far in the first half of this year, sales volume was from a dollar perspective and from a number of buildings sold perspective, are up significantly. We've already surpassed in the first half of this year what occurred in 2009. And we're expecting the second half of this year to exceed what occurred in the first half of this year. So from a volume perspective, we believe that we're past the bottom. And looking back in hindsight, clearly the second quarter of 2009 was the bottom of the trough in the volume side of the equation. With respect to value, from the peak of the market in 2007, values on average are down about 32%. Clearly, the market is in a position where it's trying to find its footing and is really not quite there yet.
Give us some good news.
The thing that, from a broker's perspective, we dislike the most is inertia. When nothing is happening, that's terrible. Now, at least there's activity, and we're expecting that, particularly towards the end of this year, we're going to have a lot of activity.
And Howard, the same question then to Bob's point to both of you.
We're talking about, the Hamptons, and they say, oh, volume was up 70% in the Hamptons over last year. Problem is, last year was zero, I mean, it was nothing. So I think you have to worry about the comps when you compete against numbers that were basically non-existent.
Yeah, Diane, do you agree with that? I mean, is that the same thing that you're seeing? Because we've had 10 years of no net stock market gain, right? I mean, so if finally start to move in the stock market.
I think the consumer confidence is definitely a factor. I have always watched that. The interesting thing I see right now, though, is we are absolutely in a perfect storm. I've been in this business over 30 years. I've never seen the perfect storm of value prices, a choice of good properties, and interest rates the lowest I've ever seen. And yet, I am seeing no urgency in the market right now. And that is, to some degree,
If you're not sure you're going to have a job next month, you're not going to buy a house or build. But do you think that New York can remain as immune as we have been the last year and a half?
It's hard to say. I mean, New York benefits from really being much more diversified than it's ever been. Still very dependent on the financial service sector. There were some good bonus news that all came out later this week, and I think that'll play on consumer confidence. And there's always a flurry of condo sales when that news comes out, so that's good. I think New York is tenuous. It's going to be tough to maintain and keep it up. So that's why I'm not quite as tight as up.
Why tough to keep it up?
Because we're really just bouncing along the bottom today, and I don't see what's there that's going to cause the growth.
But will there be a down? Or will it just be
I mean, just from observing, because who knows, but just observing, I think it's pretty flat.
Right, now Dan, this is called the road to recovery, I think, right? Jeff seems a little more negative.
There are more people talking about projects today than there were 12 months ago. Now, I do think there are,
Can they get financing?
well,
A little more negative.
there are more people talking about projects today than there were 12 months ago. Now, I do think there are,
Can they get financing?
well, I think the answer is you can get financing if you're the right developer. You can't get financing if you're like so many people that were getting financing. You look around New York, there's a little bit. You look around the country, there's a lot of projects that stand half finished. And maybe those projects should have never been built in the first place. What are the banks that have trillions of dollars worth of CMBS going to do when those loans come in? Are they going to foreclose? Are they going to forgive? Are they going to renegotiate? What's the crystal ball? And I don't think anybody knows.
Well, I don't think it's just the CMBS loans either. It's a lot of the portfolio loans that are sitting on banks' portfolios. Right now, those loans can be performing. I think one of the dangers in the marketplace is that if you look at how value trends have shifted and how loan to values have shifted, there are thousands of buildings in New York City that have negative equity positions today that are still positively cash flowing. You have these properties that still can have positive cash flow, even though they have significant negative equity positions. And the day of reckoning is not really going to come until that mortgage matures. And that's when we'll see how things are going to be handled. That's why the tsunami that we all expected to occur of distressed assets is not occurring, because those mortgage terms were so advantageous.
You really haven't seen a huge implosion yet. Why not?
The CMBS market, the special servicers have been very smart about this and effectively have weighted everything out. So interest rates are low, and they're much better off extending, modifying the loan, you're right, you can't refi, there's only one lender to refi, it's the current lender, right? So every loan is being worked out. You think that in the special servicing business, I think, can lead to a lot of new business. So if you become a special servicer, you become the workout expert for all those loans that are in trouble. So it gives you kind of eyes into the mortgage industry.
They're basically operating with inside information. It's like
it's
the
legal.
wolf in the hen house kind of concept, when you have investors that would prefer to be on the equity side, getting in on the debt side. They are seeing everything firsthand and understanding how transactions are being structured, and they have the ability to jump on an opportunity before it gets out to the marketplace.
With good credit, and I come to you and say, Ian, let's do a project. Could we get financing for that?
It's painful and it's tough. If the numbers work and you put up a lot of equity, you get done.
All right, Dan, talk to us about where geographically in New York, far west side, there's a company called Kimpton, kind of mid-side, they opened up 848. Where do you see opportunity in New York City? Or the metro area?
Well, I think that the greatest opportunity in the metro area is Manhattan. I think that, as you get in concentric circles away from Manhattan, I'm very bullish, on the west side, which is.
That's where?
Well, the Javison, the rail yards, Jeff's projects on 42nd Street, our new hotel on 44th Street. I think the way to make money is, first and foremost, you have to understand that it doesn't come easy. That, the people that came out of, the first recession I really lived through as a person at the helm of the company was the 89, 90, and then we went to another one in the late 90s, and we
It's more serious.
it's definitely more serious. But the people that come out of them are the people that were skilled, had, sort of put in their time, never ever believed it was going to be easy.
You are a deal maker. Your projects are large. You take on financial risk when you start these projects. If we had to separate, for the people in the room that want to be deal makers, access to capital, raw brain power, or cojones, how do you rank those in order of the most important thing to be successful?
It's also timing. I would say you obviously need all of those. But right now, I think the opportunity, if you look at where is the opportunity, is the new development. I think the opportunity is now going to be, as Dan said, people that have the expertise as an operator. So an operator is going to become much more important. People like Ian, who were able to take buildings and make them cool and hip and bring in the restaurants and the bars, and suddenly people were attracted to places that they never would go before, because Ian was able to add kind of the magic and the sizzle.
First off, is there an investment opportunity?
Well, the flipping business, you can still flip, but you flip for a loss. Look, I never thought realistically that, people should buy residential condos and co-ops to try to flip them.
Why not? It's incredibly
You know what I think you're buying them to live there, and then if it goes down a little bit, who cares? If it goes up, we're happy. I don't think, I think it's too hard to find the market. And with closing costs and commissions, which of course we love the commission part of it, but with that, I think it's a tough thing to do in New York, okay? Personally, I bought things in Miami, last year, that were sold at $700-800 a foot, which we're selling for $200 a foot. Now, I don't think we're ever going back to $700 or $800. Maybe they'll go back to $400. Some of them have it. So in a real depressed market, then you could rent them out, and you could basically cover your maintenance and your real estate taxes and get maybe a 1% return on your money. Okay, but I think that's a less risk scenario. I just don't see buying apartments in Manhattan for spec.
This is going to be a very uncomfortable question for you probably, but where are commissions going? I know the headline is still 5.5%, 6%. Where are deals getting done?
It's still 5.5%, 6%.
Bob, where are you guys making, obviously distressed is a big part of massing capital right now. When that slows down, what picks up? Where's the opportunity?
Well, fortunately, I think that the distress component of the market is probably going to be with us for another 2 or 3 years at least. And we could get into a situation where we have a market that's moving in two parallel paths, one positive and one negative. because the amount of over leverage in the system is at an extent to which it's going to take a lot of appreciation to bail those properties out, to get positive equity positions again. So I think to the extent that we get into a position where fundamentals start to improve, value starts to improve, we could see some very positive things for people who are riding the train on that track, while there's still some pretty negative stuff going on for people who took on too much debt. And leverage, when things are good, creates extraordinary results, but leverage, when things are bad, creates extraordinary distress. And, real estate is never bad.
But I want to thank all my panelists, Ian, Dan, Jeff, Howard, Dan, amazing job.
While the market has been depressed, real estate pros have said that there are some reasons to be optimistic. Hopefully next year the market will be even better. We look forward to seeing you next year at the Real Deal 7th Annual Forum. Thank you. Lauren Elkes, The Real Deal.